I intentionally did not do a video yesterday, given what happened with the Charlie Kirk assassination. I just didn't think it was appropriate to come out here and discuss economics when what got presented, I think, to us as a country yesterday is far greater than any economic discussion we could have. Everyone's got their opinion. Obviously, I have my own opinion. There are many hundreds more on YouTube that have much greater platforms than me that are expressing real concerns about where we're at as a country. So today I'm going to discuss the topic I had set for yesterday, but I put it on hold, and we got more data out this morning on inflation numbers. So I'm going to tie it all together. So appreciate you guys watching all the way through. If you can, I'll try not to go too long. Thanks for subscribing to the channel if you're not subscribed. We are growing, and so I appreciate you guys very much. So today, out of the zero hedge, after 4 years of showing no signs of life, initial jobless claims surged higher last week with 263,000 Americans filing for jobless claim benefits for the first time. That is the most since October 2021. The expectation was for 235,000 filings. They got 263. That was up 27,000 over last week as well. And the continuing claims right now in this country for unemployment benefits is 1.9 million Americans. That's also the highest in 4 years. About October 2021. What was the United States economy trying to recover from in October 2021? We all know the answer to that, okay? So yesterday out of CNBC, again, talking about the destruction of the middle and lower class, Wells Fargo CEO comes out, CNBC yesterday, and says he sees more downside to the U.S. economy as lower-income consumers struggle. Wells Fargo CEO Charles Scharf said Wednesday that while corporations and high-income consumers are thriving, discuss it all the time on this channel, lower-income Americans are struggling to stay afloat. There are signs of stress among lower earners, Scharf said in an interview on CNBC's Squawk Box. And he says the low end is spending the money that they have, so their balances are below pre-pandemic levels. They are living on the edge, he says. So on the heels of what we're hearing with more unemployment claims being filed, more continuing claims ongoing, consumers struggling, I just checked the markets today. The markets haven't closed yet. They're about an hour and a half away from close. And the Dow Jones is up 610 points, right? NASDAQ's up 158, and the S&P is up 52 points as of recording. And the top story on CNBC right now is Dow jumps 600 points as record August inflation increase will not derail the Fed rate cut. So the markets are rolling, right? Making new all-time highs because today's inflation data wasn't bad enough to derail the Fed's upcoming rate decision. I'm going to discuss the inflation figures with you from yesterday and today real briefly. 10-year yield is down to 4.01%. You've seen nothing yet, folks, okay? You think your ability to get returns on your money and be a saver in this country is going to improve. It's not. It's going to get decimated. And so we have futures markets now predicting 100% probability that the committee, the FOMC, will approve its first rate cut since December 2024. So let's talk about yesterday. We got wholesale prices. That data was released, and it said it unexpectedly declined 0.1% in August as the Fed rate decision looms. Producer price index fell 0.1% in August after a downwardly revised 0.7% increase in July, and well off the Dow Jones estimate for a 0.3% rise. The release provides, it says, breathing room, again, for the Federal Reserve to approve an interest rate cut at its meeting next week. Services price is a key metric, it says, for the Fed when evaluating the stance of monetary policy, posted a 0.2% drop. So that was, again, taken by the markets yesterday as good news on the inflation front. Then today we get CPI. Consumer prices rose at an annual rate of 2.9% in August. And it says it posted a seasonally adjusted, and this is out of the CNBC article again, seasonally adjusted 0.4% increase for the month, double what it was last month, putting the annual inflation rate at 2.9%, right, the official number, up 0.2 percentage points from the prior month, and the highest reading since January. Economists surveyed by Dow Jones had been looking for respective readings of 0.3% and 2.9, right? So it was higher on the CPI. This is for the vital core reading that excludes food and energy. The August gain was 0.3%, putting the 12-month figure at 3.1%, both as in line with forecasts, right? And of course, as Fed officials consider the core CPI to be a better gauge of long-run trends. So, guys, we're going to get probably either at least a 25 basis point cut next week, maybe even a 50 basis point cut. The markets see it. The 10-year is obviously baking it in the cake right now. But let me explain, and that was the reason for the thumbnail for the show, for the video today, which is that the suffering is going to continue for most. I started the show by sharing with you the unemployment benefits and the comment from Wells Fargo CEO. But here is why, love to get your thoughts and input on this. This is why rate cuts, guys, are not going to solve the problem, okay? They're not going to solve the unemployment problem. They're not going to solve the continued issue with layoffs. They're not going to solve the consumer debt problem in this country, okay? So the large swath, if you're not in the 1%, is going to continue having their standard of living and their quality of life deteriorated, okay, by this so-called great news of Fed rate cuts. So this is why. Number one, even if rate cuts result in rising demand, companies right now are, as we know, been sharing for weeks on the channel, a month, companies are investing in AI. They're cutting tens of thousands, just the beginning, of positions because they're shifting their business model to use AI whenever they can to maximize efficiency, to maximize profits for their shareholders. Number two, once you start reducing rates and providing stimulus, right, that will, discussed also on the show, fuel inflation, okay? So they're going to have inflation go rampant again on the other end. And of course, what does that do? That hurts job growth. It works against the creation of jobs and job growth in the country. Number three, if businesses and consumers, which we know they are, they're already maxed out. They're already maxed out on debt, and they have their confidence level is no longer there, either in the dollar or the economy. Okay, so once that happens, cheap credit doesn't really spark any more hiring. It doesn't spark the ability of consumers already maxed out on credit cards and they've got a terrible credit score from going out and borrowing more money, okay? Maybe it helps them with their monthly credit card debt a little bit, but not enough to be meaningful, okay? And lastly, even if these rate cuts start getting rolled out, it sometimes takes months or years for it to actually translate into meaningful job creation. Meanwhile, AI is going to keep chopping jobs off of every industry in this country, okay? The last thing I want to share with you is Business Insider yesterday And it again feeds a little bit on something I shared on a show a couple of days ago about this whole rate cut. The markets are cheering this now, but it very well may end up being a buy the rumor and buy the rumor and then sell the news when it happens. And JP Morgan is warning exactly of this for you market people. JP Morgan warns the Fed's next rate cut could be a sell the news event that tanks stocks. Again, out of Business Insider yesterday, I'll share a couple of the key highlights. Investors are clamoring for rate cuts to keep the stock market's bull rally going. Look at today's rally again, right? But there might be a problem with the overwhelming positive view of, it says, loser monetary policy, according to JP Morgan on Monday. They said this week that the Fed decision on September 17th could end up sending stocks into a tailspin as investors sell the news. And they say we have concerns that the September 17th Fed meeting, which delivers a 25 basis point cut, could turn into a sell the news event as investors pull back to consider macro data. Fed's reaction function potentially stretch positioning, a weaker corporate buyback bid, and waning participation from retail investors, they say, could feed into that narrative. And on a show a few days ago, I discussed with you what happened in 2007, okay, with the September Fed rate cut to the S&P 500 after successive rate cuts were implemented. The S&P 500 went on a massive decline. Again, not a economist. From a layperson's perspective, I'm saying you've got to pay attention to, history, okay? Because it very well may repeat. All right. So with that being said, I'm sorry to go as long today. I wanted to kind of pull all this back together for you guys. What do you do? Okay, if you are not in that top 1%, if you're not self-employed and controlling your own income, right? If you don't have your side gigs, you don't have, a bunch of money in the bank and investments and gold and silver, and stocks, you've got to start paying down that debt, folks, and get out of the debt trap as best you can. Again, you've got to probably hold on to the day job as long as you can while you continue to muddle through this nightmare. I hate to say it, but it's probably not going to get better anytime soon. Rate cuts do not happen when things are good, all right? No matter what the stock market tells you, no matter what CNBC and Jim Cramer tell you, folks, you've got to keep your head down now, really focus on a game plan to improve the situation. I know at a time when many feel like they're taking one step forward and two steps back. Again, thanks for supporting the channel. Leave me a like if you enjoy the content. Subscribe to the channel if you're not subscribed. Leave your thoughts and comments. With that being said, talk to you guys soon, okay?